Mark Selby, how are we doing, sir?
It's great to see you once again, Matthew.
Thank you. Well, it's nice to have you on the show, as usual, for our little weekly slot in the world of nickel.
Yes.
I was kind of like, we're gonna next week. We're gonna do a kind of roundup of the year and sort of see what's happened, because obviously the price has really moved considerably. So we'll save that till then. So why don't we start off with maybe a look at the old triangle again, just see what's happening.
It's been nickel has not been as exciting the last few weeks as copper's often referred to as Dr. Copper. Copper broke through another level. It's now $3.50 a pound, $7,700 a ton. That is more than 50 cents a pound in just over a month. So, again, the kind of price moves. Again, started with the rebound and reflation in China. And again, what people are saying now is, they see enough signs in the global economy, global industrial economy, that Dr. Copper is pointing the way higher. So now nickel had not participated the last few weeks, in that move up with copper. Oftentimes you'll see all of the base metals move higher together when you get that kind of global economic trade. And again, we've seen zinc and some of the others move higher, not to anywhere near the same extent, but nickel actually got to participate a little bit this week. We back up to the highest it was since last fall. Looking at $16,500 a ton. Or up over $7.50 a pound, which again is a great price. And I think all it took for nickel to join the party this week was. We talked pretty extensively last week, and just in terms of how a lot of the triangle was pointing down. Stainless inventories dropped again, which let stainless prices stop dropping. And inventories are as low as they've been since last January, when you saw with COVID a pile of inventory come in at the start of the year. So the inventories are still up year over year. But again, in the market, sometimes when something is less bad is enough for it to make it move higher. And that's what we saw in nickel this week. Again, I would not say the triangle is anywhere in a good place to sort of point that, China's going to pull things higher at this point in time. But, it's sort of again, I would still say it's a neutral to down space. So, let's watch what happens as we come into year end here.
Yeah, it's been amazing. I mean, copper's had a really, really good, well, as has nickel. I mean, but you've both done probably better than gold in it if you measure it in the right way.
Oh, and gold equities. I mean, that's one of the things we'll talk next week. I'm, again, as a commodity analyst, I do this annual forecast that I talked about. The slides from that last week, and again, I always in my forecast always talk about how right or wrong I was the prior year, because there are zero commodity analysts who do that each year. So what I'm going to do is go through some of the calls, and if people want to point out calls I made that were right or wrong, let me know. But the one I think that was great was that sort of early mid-May call to back up the bus on copper stocks, which have more than tripled, quadrupled in some cases. So it's been a pretty exciting 6 months.
It's been amazing, and I think just not to perhaps talk about Canada nickel here, but the zero carbon initiative has been fantastic as well. I think that's something we'll talk about next week. I think a little bit, because we have people like who we had on this week, Champion Iron, who are seeing that happening too. They're very conscious of the carbon credits side of the business as part of the story that they need to tell in the marketplace. So companies like you, like them, and others are latching onto that, and I think the market is giving you credit for that. So I think that'll be a good conversation to have next week too.
Yeah. Quebec and Northern Ontario are in this great place where it's all hydroelectricity. So with the zero carbon electricity, it makes it really helps on the carbon footprint thing. One thing in terms of calendar too, just in terms of seasonal timing, it used to happen in the second half of December, when 15 years ago, when it was just kind of the West primarily in terms of dominating commodity trade flows, and it's now moved into sort of December into January with Chinese New Year. Is that again, people are closing their books at the end of the year, and what happens is if you have a disconnect between where people think the market's going to trade in the first 6 months and where the current price is, you will see them in those time periods where the amount of trading drops. It makes it easier to give the market a big shove. So you used to see these price moves happen in those final few weeks, which are always a good sign of where things might be headed the next 6 months. So again, given this sort of disconnect between LME prices and sort of the current fundamentals, in China, I wouldn't be surprised if we don't see a material improvement in that triangle over the next 6 weeks. That people might take this as an opportunity to give the market a shove lower. I think that that was part of what was behind the move last week. But I think could see another few shoves downward, in the short term here. So.
Okay. Well, we'll do a little summary next week for everyone on that, and a bunch of different stuff. And we'll have a big week next week, because I think some massive learnings this year since we've been talking to each other. I've learned a lot from you, about the market, not just about nickel, but just in sort of trading and stuff. And we're going to talk a little bit in a few minutes about capital raising on ASX versus TSX.
Yeah.
But before we do, there's one thing that we talked about in the past, sort of almost jokingly, is the way that companies have to end up changing the names if they have to segue, flip-flop from one type of commodity to the next, just to keep things going, and to be able to raise capital to kind of keep things going. And I think we're going to talk now about one we have talked about in the past, which is Chalice Gold, or as it's now called,
Chalice Mining.
There we go.
Given that their primary asset is now a palladium, nickel, copper, cobalt story, that's been a great success. Again, we need all the nickel discoveries we can. Unfortunately for the nickel market, this is turning much more into a palladium play. But I mean, in terms of for their shareholders, it's been a great story. And they just finished raising $100 million, which will take them through scoping study and pre-feasibility study, plus drill out, the rest of the land package. One thing that I think they've done a very good job in, the actual part they could drill right out of the gate was only a tiny fraction of the entire structure. The other part of the structure was in a forest, a park, in Australia. And they've been very upfront about that the entire way, and they're applying for permits now to drill in there. And some of this money is going to be to drill, some of the targets in there. I can tell you there are a lot of other companies, I think on one of our earlier ones, we talked about the importance of understanding exactly where the thing is. And I know a few projects, particularly that were on the edge of national parks, and maybe they didn't quite ever highlight that kind of thing, because sometimes environmentalists don't like when you put a mining project, on the doorstep of a park. So, but no, in this case, they've been 100% transparent, and, again, Australia is a pretty mining friendly jurisdiction, so it looks like, they're going through the process. They have to go through the process, but they will get there. The other big capital raise in the last few weeks, we neglected to mention, was Talon did a bought deal financing for $10 million, which again is good to see all this capital flowing into, nickel or nickel close to nickel, in the case of Chalice, type deposits. So, but again, I think for me, what it highlighted was the two differences between, the bought deal is a sort of a unique TSX vehicle that I know drives a lot of investors in Europe crazy, because they just don't get. It's difficult for a lot of people to get access to it. And again, there's that's the one thing is there's, the whole capital raising thing between both markets is very, very different.
Well, yeah, we should talk about that. Okay. In fact, Talon is worth mentioning. Then I think, Howard Klein, who does a regular lithium show with us on again next week, he raised part of that money for Talon, and he thinks it's a good story. And let's see what they do with the money. I guess that's the.
Oh yeah, no. Again, we need every high grade. We need every nickel discovery period.
Absolutely. So we're all part of the same team.
Exactly.
Right.
Team Nickel.
Team Nickel. Well, let's talk about that. The differences between raising money on the TSXV versus ASX. Because we've sort of seen companies. Well, we interview companies on both exchanges, obviously, and we've had Australian companies come on here and tell us their story, and we are quite often surprised at the information that they present, that they're allowed to present or not allowed to present, and the way they choose to display that information, and how investors can make honest decisions off the back of that. And, TSX, has a different set of, pluses and minuses with this exchange. So why don't you talk us through your experience? Because you've sat on both sides of the fence.
Sure. So, I'm obviously far more familiar with the TSX. So if I do slip up, on the ASX stuff, I'm sure people will point that out. I in terms of capital raising, I far prefer the ASX model. You can halt your stock, so there's no issues in terms of people who know or suspect you might be doing a financing, who short your stock in advance of getting the deal done, which makes it difficult to actually have sort of open conversations with people about your capital financing needs, which again, I think would drive people crazy. It's like, well, you were just talking last week and you said you didn't need any money, and then you just did a $50 million bought deal. It's CEO suspicion that if any word gets out that they're going to raise some money, all of a sudden they're going to be staring at a share price that's going to drop 15% in a week. Yeah. So the ASX, they halt the stock. You get your period to raise your capital, and then you can start trading again. So there's none of the shorting. It allows retail investors, and again, what you see much more often in the ASX are rights issues where every shareholder, gets to participate, has the opportunity to participate in that financing at the time. And so on the flip side, the TSX bought deal vehicle. And again, the bought deal is nice because you have certainty that it's going to happen, except for extreme cases like we saw. There was one bought deal that fell over in February, March, as COVID was collapsing. There's a extreme, thing happening, and the banks, decided to do that. I think they ended up raising some more money at another price at some point. So it wasn't total tragedy, but, no, in terms of, the bought deal, it means generally, okay, the brokers are sort of in, have a few people they've been talking with who are going to get the lion's share of the deal. You obviously have an opportunity to upsize it or whatever, but it makes it very hard for retail shareholders unless you have a brokerage, account at one of the brokers, that's participating there. Two, again, if you're in Europe versus North America, again, larger institutions that have global desks and so forth, are generally able to play, but a lot are, smaller guys, who are managing decent sized books, but, aren't, they just don't have the opportunity. And again, you're looking at, a bought deal is typically done at a, 8, 10, even larger discount. The permitted discounts can be as low as 20 or 25%. So, again, when if you're managing a fund and you're not getting the 10% cheaper stock, out of the gate, that's a massive disadvantage. So I think the structured, ASX approach is much better on that front. On the other part that the ASX does very well is, companies need to have the top 28 shareholder list. Like they know who their shareholders are. Unless someone, I know, where we've placed stock, and I know from talking to them whether, they're buying, but unless they're over 9.9%, there's no mandatory filing requirement. Some fund, if you're a large fund, you have to file your holdings each quarter, a few months behind. So you get some glimmers as to where the shareholding is. But again, the ASX, companies know who their largest shareholders are, which is great. And again, with that transparency, it prevents some of the gaming of, okay, if I'm a large holder, I like the stock, but hey, if I can, basically there's liquidity that I can hit, if I get my fill from the broker and get the stock at 10% cheaper and move higher, it's like, there's a lot of guys, and they do that trade, all day long. On the flip side, where I think the TSX does a better job, maybe a little, sort of too transparent, is filing technical reports. I'm amazed, that poor investors looking at ASX stock have, the press release and the relatively detailed press releases that, in terms of the information that are provided, but it's just that press release and then, slides and an investor deck where you kind of have to, try and understand, what that deposit could be worth. And the reality is, even if it's a fairly detailed press release, you're only seeing sort of a handful of assumptions that are there. And you don't see the other 200 assumptions, that go into building something like a mining cost or a milling cost or, a bunch of other, sort of key components of that. And so, again, that part is much more management friendly. And the other part that's very sort of management friendly and not shareholder friendly in Australia is, hostile bids are required to have an independent valuation done. So it just creates this long time period where, it allows the management to go out and shop for higher bids, because it takes away any kind of deal certainty. You don't see many hostile bids come through, in Australia. So, which again helps entrench management a little bit, which isn't always the best thing for shareholders.
Fascinating. Loads of questions. So, I'm going to come at it from the retail perspective, okay? Because for people like me, I get invited into bought deals, private placements, because I'm putting down a big chunk of change, right? And that's great for me because I'm one of the privileged few who gets to see a deal early. I can assess the deal whether I like it or not. If I don't like it, I walk away. If I like it, I'm in. I'm in way ahead of everyone else. So in terms of the retail audience, right? So that automatically unfair to retail, in my opinion.
Yeah.
And the way you describe both exchanges there, and obviously there are other exchanges and they will behave roughly the same way. How does it become fair for retail? Because there's the regulators and then there's the exchange, different entities, right?
Yeah.
And the regulator's job, and it's a tough job because they've got so many moving parts to look at and they've got to focus where they spend their time, money and efforts to protect retail ultimately. Usually they go for the big boys. The exchange is a commercial venture. And it has to follow certain rules. And again, it's limited in terms of its finances as to where it spends its time, money, and attention. Yeah. And I hear, and I have this conversation a lot about, we talked a few months ago about the behavior of certain companies and, which practices which certainly are morally challenging, yet nothing has happened. Where shareholders lost a lot of money off the back of, I think we all know what we're talking about here. People have lost money off the back of the company pumping a story which they knew not to be true. Okay. The exchange has done nothing. So yet again, unfair for retail investors who are probably the ones who got caught out there. Okay, I would assume. So do you think that regulators need to do more with the exchange to help retail at that level rather than going after the big project, the big guys? How do we make it fair across the board? Is it possible?
Yeah, no, I think again, there are components to the capital raising piece. I think that sort of having more rights offerings where effectively every existing shareholder gets to participate in the new financing is a good model. Again, allowing a company to halt the stock so they can have a reasonable set of conversations around what a financing might look like. Again, just makes it fairer for everybody to get access, to the information that's there. In terms of, the whole JORC and 43-101 were a response to the debacle that was Bre-X, in terms of providing technical information. But again, I would say, again, I think it's important to have, a lot more information available. So, the whole having 43-101s is good. The tricky part is, again, if you think about it from a the one thing from a company perspective is, oh, okay, I have given you, the entire guts of my business, so you can choose to, you've got everything you need to fully value if you're going to take my company over. So, that from that part, maybe there's, a bit too much transparency on that front, but I would far rather have that information out there because the way I would approach it, one is, again, even on a TSX perspective, remember a technical report if someone signs a technical report and you see a number in there, that does not mean that number is right. We've talked many times about benchmarking operating costs and capital costs. Again, all that means is that number, there's some person who's comfortable putting their signature, who holds a professional designation, a qualified professional designation, is willing for, a price to sign, because they get paid for producing the report, putting their signature on that report. With ASX companies, again, because you have a lot less information that's there. I think I'd encourage people to say, okay, what you're looking at, that shows up in that press release is kind of an iceberg of information. You get a little bit that you can see, but there's a whole pile of assumptions on, that you can't see, below the water. So, judge those, if they're being really aggressive on the assumptions that you can see, then there's probably a pretty good chance they've been also equally or more aggressive on some of the other stuff. So again, that's where it comes into the benchmarking, because in the end, they're going to come up with an overall operating cost and an overall capital cost. And so, look at other similar types of deposits to see whether, those numbers are even in the zip code. And I can tell you, a large portion of them from stuff that I've done due diligence on with various companies over time when looking at assets is, that what's published in the 43-101 and what we actually think the numbers are not even close.
Okay, it's the same from banking days when we got into data rooms and we started breaking these things down. I'll tell you, I 100% agree with you. Very rarely, it was the best way I can put this was they were putting the best case forward. At its worst, people were signing off on stuff because they were worried about being paid a check by the company. Right, that's the reality of it. And I'm not talking a little bit off. I'm talking a whole lot off, as in commercial imperatives kind of level of off. And that's why I'm quite cautious and nervous here. And I agree with you with regards to, North American. I like the fact that there's a lot of information. And I know what you're saying when you say perhaps too much information. You're talking about keep a competitive tension if you're selling. If you're a seller, you don't necessarily want them to see, you don't want to be standing there completely naked. You want some mystery to the debate, the negotiations. Whereas ASX, we've seen, and we've had a few companies come on the show who release the information they want you to see. And by the way, it's not even information that's necessarily been signed off. It's the information which is their interpretation of the technical report, which is, again, usually from our experience, my banking days, way off the mark. But it makes it very difficult to work out, do you base it on fundamentals? Do you do sentiment in the market as it's generally going that way? How do you measure it properly? Because the peer analysis and the benchmarking gives you some idea of where the numbers should be or probably realistically are. And when I go over to the kind of North American side where I've got all of this technical information, I find it much, much easier. So that's why we probably spend a little bit more time on the sort of North American side of investing, because Australia seems a little bit frothy in places. And a little bit less open to us. It's not to say we haven't got investments there, we have, but it just makes it harder to manage. And you've got to go on people's word. That's not something I ever invest on, ever. No.
And the other thing to watch for, and what's helpful is where you see, I call them sort of endorsement investors that if you see, like Resource Capital or Orion or one of the other companies that does, a very comprehensive technical due diligence, or you get a major mining company that would have done they get to see the gory details and, they're comfortable in the gory details, to have that investment made. I mean, that was in my past life with RNC, with Dumont, one thing, that I was always, very proud of the fact that, pretty much, I think every significant technical due diligence done by a serious investor, we passed with flying colors. They would say, look, we're sometimes skeptical of these low grade deposits. I mean, Dumont, we were sort of breaking new ground, which we're then getting the benefit of following with Crawford. But again, the ability to stand up to that kind of scrutiny. And, we had Orion come in as an investor. There was another very large company who I won't mention that was the sort of second place there. And there were some significant corporate people who were going to make things happen and then unfortunately fell away for completely non-technical reasons why they didn't make the deal. But, having gone through those processes and say, yeah, no, we actually believe your numbers is a massive endorsement. So again, that would be the other way, to get comfortable. If you're nervous at all, just wait and see if one of the sort of more serious, mining investors, really gets involved. Again, they're not perfect. There's been lots of opportunities where but it's better than nothing in terms of, rather than sort of closing your eyes and pressing the purchase button on that.
No, I like that. I think there's some obvious players like the Orions and the RCFs, and there's probably a handful of companies rather than cult figures, companies who I know that's been properly analysed, and I suspect they know what they're talking about because they're as rigorous as we would be. So if I see a certain name attached to it, now if I see a name that's been attached to it for a long time and the company hasn't moved, I'm going to wonder, is that a factor of market price, or are there others, jurisdictional issues? And we've got to try and understand that. But more times than not, those companies get it right. Not always. Not always, because I look at some stories from people like Greenstone in London. They're struggling on a few fronts. So again, just look at their track record of success. Right?
Yeah. Again, the way to do that is the way to look at that investment is they've looked at it from a technical perspective and are comfortable with the technical. What those groups aren't necessarily always good at is one, understanding, is this the metal of the moment, and is this metal going to, because again, they have longer dated funds. They're not looking to say, okay, is the price of this metal going to go up in the next 12 months, right? So, that's number one. Number two, they're not looking at it from is this a kind of story that's going to get great traction in the market, and is the person running this company a great marketer? So they're going to be able to sell the story, as much as we like it, that's there. Again, there's situations where that happens. And then there's a third situation where sometimes, these guys had it pretty good, where they were the only source of capital, and particularly past the exploration stage capital. And so in my view, I think they got a little bit greedy. And so, again, they're getting, maybe it's convertible with a fairly high coupon. They're getting a royalty on the top and a stream, and then all of a sudden it's like, again, they're not helping themselves where, the deal that you got the endorsement from, is taking a big pile of the cream off the top. Again, that's some of the reasons why I think some of these, stories where, again, you get the technical endorsement from these guys, but then the stock doesn't go anywhere for 2 years. And, again, sometimes those guys aren't helping themselves by being just a little, they need to leave some for the other, a little more of the pie for the other investors.
Exactly. And that's why I mentioned personality of the cult, because that's the other side of this. You don't necessarily need to have a technically success or likelihood of a technical success with a project for it to do well, to be able to make money. But you need to be damn sure when to get off that train, because it ain't going to work. It ain't going to become a mine. It ain't going to produce revenue. It ain't going to make money. Okay, so there are lots of stories like this, and I'll name one. And the personalities don't signal when they're going to sell. Of course they don't. Of course
they might get out before you do. Right?
Yeah, so you're going to get in later than them, which is fine. You're gonna get off later than them, which is not so fine, because usually that's the beginning of a very quick and rapid descent. Okay, so that's the truth. And I'm gonna name one here, because I think, like I say, you can still make money on doing this, right? So I'm not having a go at the ability to make money. So if people are invested in it, it's fine. But I'm looking at a company like, I'm going to say uranium company. Okay, there's a company called UEC. It's a very good promoter CEO called Amir Adani, and he's done very well for himself. I think the share price has suffered a lot. But if you're coming into that company now, it's at such a low price at the moment. They are supported by some pretty big promoters and personalities in Canada. And those guys need this to work, so that they will make it work despite the physical attributes of the asset. Okay, and there's no disputing the kind of the physical asset component. I've spoken to way too many uranium people on the inside and in the know who've been at those assets, they know what's there, and it's not a lot, okay? But that doesn't matter in the sense that this company will take advantage of the market next year. The share price probably will increase, and you can make some money too. But someone at the end of it is going to be left holding the shares of a fundamentally worthless, well, a company which is worth a lot less than perhaps the market would suggest, okay? That's a real life example of where the personality of the cult or cults who are pushing an agenda can make something which technically will not work as far as the market's concerned. And we see that a lot. And we're seeing a lot of gold companies dusting off old projects which just don't work at certain prices, or perhaps, will never need a lot higher price to work, but they're getting the coverage. And that's the games that are played in the marketplace. And being able to, as you say, do the analysis properly and pick something which has a technical success of working is great. But a lot of people play the game where they don't care. It's a case of, if the market sentiment is that this thing will become good, you can make money if you get in and out quick enough.
Yeah. Oh yeah. No. There's, in places where there's a lack of information, again, just following, so and so bought it, or so and so, billionaire bought it. And, there's lots of people that's all, that's a huge portion of their investment criteria. And again, as long as you're sort of quick in and quick out, then, yep, you can make a lot of money. And I know people have made a lot of money, but, those are hopefully some of the other ways, to take a look at some of these ways to get in.
Oh, it's murky and dirty. Yeah. Hey, on to other things. Cobalt. We're going to bring Cobalt to the party today, and we're going to start talking about it regularly next year as well. So we've got someone who's going to come and talk about the world of Cobalt. So interesting times for Cobalt at the moment, wouldn't you say?
Yeah. No. I think it's. I get asked, sort of nickel. It's copper and cobalt together, or nickel and cobalt together. And so I think again, it's again in smaller volume metals, it gets really tricky. And again, when metals, we have a very limited number of uses, and again, you don't have a large number of suppliers of that metal. I would say, and again, pointing at price assumptions, just because prices were $50 at one point, if you then take a $25 long-term price, that doesn't necessarily, just because it was half of what it was recently, has no bearing on what it really is going to be in the future. So, again, I, encourage people to take a look at, okay, what have prices been over a 25-year period, and, where is their current price assumption relative to, that sort of longer term trend? Because again, things change for sure, and EVs are a massive, we talk a lot about that, and, it is going to have an impact, for a period of time, but, there's the reality of the cost curve, and there's the reality of market dynamics, and, those things, do happen. So, there are still a lot of $25 a pound cobalt prices out there. And again, I think it's going to be, sentiment on cobalt is changing. Cobalt's going to have a tough row here because it got hit by oil and gas. It got hit by aerospace, and then the turbulence in the EV market. Now, again, from my nickel presentation last week, I think, EVs, you're going to see pretty steady month over month gains now in China. So cobalt's going to get sort of some upward ascent from that. But, again, I think, there's some very big players who are in this business who realized, some bad things by having prices at $50. You're going to get bad supply that shouldn't come on. And again, bad supply, once it's on, it doesn't turn off for a very long time. And again, you just, in terms of substitution, we saw, honestly, like if you go back to battery presentations from 2 years ago, people were saying we were going to get to 811 being a dominant kind of by 2023, 2024, maybe 2025, and that we're going to move somewhat towards the 50%, 523, 622s, by 2022, 2020. I mean, we're already at, most 523, 622 is the dominant, and 811 and 90505 is where we're headed in a year or two. So, that's the danger when you get these crazy price spikes. So, but again, I think it's going to it'll be a very, very interesting metal over the next few years as all that stuff gets sorted out.
Great point. We need to remind ourselves this whole battery revolution. It's early days, nascent technologies in many ways. There will be multiple use cases and multiple designs, and there'll be winners and there'll be losers. But always important to kind of keep your eye on that macro story. One thing we forgot to talk about, which was we had Blackstone on earlier this week.
Yes,
very good.
I know, and some awesome drill results. So again, some nice, decent thicknesses of 0.5 to 1%, material, which is, very open pittable kind of, and where they're drilling is open pit ready. So, and again, they've got the joint venture with EcoPro, who I know are one of the more, from past life, one of the more sort of dynamic and interesting, and really, again, trying to integrate the supply chains there. So, it was good to see. And again, as I say all the time, we need all the nickel we can get. So, it's good to see companies succeeding and continuing to find more of it. So.
Yeah, it was a good chat. It's actually in a club at the moment. Obviously, I think the relationship with EcoPro, we sort of dug a little bit deeper to try and understand what that looks like going forward. Does Scott remain in control, or is EcoPro at the helm? More drill results coming in the new year. So yeah, I think they're starting to get that hang of that story now. As they're more of a player. I think people should take note of them, and certainly watch the video, because I think he did a good job of explaining what they're trying to do. And then the other one was, I've got two more for you.
Okay.
Wailu, young Andrew.
Yes,
he's been at it again.
Mr. Forest.
Yeah.
Twiggy. So he picked up a stake in Noront. From Resource Capital Fund. So Noront is the Eagle's Nest nickel, copper, cobalt, and then they also found massive chrome. So again, the Ring of Fire was big news back in the mid 2000s. It was a brand new greenfield discovery. They have an A1 team, Alan Coots, ex Falconbridge, and it's got a whole very senior, probably I would say the one of the best teams in the nickel business in terms of the development capability. And so the challenge has always been it's in a remote location, but they are working with the governments and First Nations groups to get the infrastructure that's there to do it. So I think it was a good endorsement. That Wailu is the holding company or the sort of private investment arm for Andrew Forest for exploration stage assets. Now, the reason RCF was selling, again, private equity funds raise money for a period of time, and at the end of that fund, they need to close it. And again, switching investments between funds it gets very complicated, and they try and avoid that at all times. So, again, sometimes when you see private equity firms exit positions, it's because they're wrapping up, a particular fund. It may or may not have anything to do with the view on the asset itself, but that's the thing, and it's great for Noront that it ends up in a very strong partner's hands. Again, we need all of the nickel discoveries we need, so it's good to see a new person, and again with a lot of nickel exploration experience, be able to bring that to bear.
It's a nice sort of clean end to it. We've seen those scenarios where funds are trying to offload and they can't. Sierra Silver is one that we've had on a couple of times where that's causing problems, and it's meaning that the share price doesn't move and the shareholders are uncertain. There's overhang. There's all sorts of things going on there. So it can work well. Sometimes it's more problematic.
It was a great outcome for Nora.
Yeah, fantastic.
I was very happy for Alan. Yep.
And Poseidon Nickel have halted their stock. What's going on?
Yeah, no, that mine is I think the highest operating mine. Good luck. Grade mine. Silver Swan operated in the mid 90s discovered by Outokumpu, or was overseen by Outokumpu for a while. Then they have a larger lower grade deposit. They have a nice big size mill that's sitting there. Again, Andrew Forest, I believe, is a shareholder of that company, as well as a U.S. private equity firm And they've got Peter Harold in there running it now. And so again, they've got a new ore body. I think it's called Golden Swan. And again, you're getting, even rarer than a single, something north of 2% nickel is when you get, close to double digit, nickel grades. And they do get some of those there. So I'm very curious to see what's going to come out tonight they said they're going to start trading again on the 14th. So again, this is great that the ASX does this. If you, some shiny core, you can halt the stock. The drillers can't, tell their friends to go buy the stock. It's again, the ASX approach to this is very, very good. Whereas the TSX, if you halt your stock for more than a few hours, they get all grumpy. So, it's good to see, and I'm very curious to see. And I hope it's a nice, good intersection.
Fantastic. So Golden Swan, possibly Golden Goose, lovely.
Yeah.
Or
a whole flock of birds.
A whole just flock of golden, whatever you want, chaffinches. Well, I think that's the news for the week. So I was trying to, when you were telling me that, you were saying something about the you can't. It's been halted, so people can't go and tell their friends and family to go and buy stuff. Were you telling me the story about how there was a stock which was they were trying to work out how information was being leaked about
Voisey Bay
drill results. I love that.
Yes.
Go and tell us again for people who missed that one.
So Voisey Bay was one of the great discoveries, of the last 50 years, and so there was, I was told by someone who was involved actually on the ground the story. So this is a firsthand story. So it was a beautiful promote by Friedland, which was a great payday for all the Diamond Field shareholders. But anyways, there was one point while they were drilling this deposit out that the news was getting out, and they couldn't figure out, where this news was coming from. And then they finally figured out what it was that the helicopter pilot. I mean, when you have massive sulfide, and again, Voisey Bay was literally like pure massive sulfides, that's very, very heavy. So what they figured out was the helicopter pilots, if they pull up a skid of drill core, they could tell whether they'd hit something or not, right? They know, okay, geez, this is one of the heaviest loads I've ever lifted. And, 2 weeks later, drill results come out and the stock goes up twofold. People can figure things out pretty quickly. So what they actually had to resort to was layering in empty drill core boxes into the stacks, just kind of throw people off in terms of, how much high grade core was actually coming out there. So.
I love that. We learn and adapt. So the cores were being flown out by helicopter to the assay labs, and the helicopter pilot could work out by the weight how much metal was contained. And if it was heavy, buy. If it was light, sell. I love it.
Yeah.
What a great story.
There you go.
Right, Mark. Beautiful. What a great. I'm looking forward to next week though. Oh boy.
Yes. No, me too.
That should be a good one. We're going to look back, which is going to help us, therefore, look forward as well.
Sometimes right, sometimes wrong. We'll find out just how much.
No, I was once. Oh God, we had a sort of planning director at our at the bank, and he was a really nice guy, not married, nice guy, and he'd say, "I'm always right and I'm always beautiful." That was his life.
There we go.
That was stuck with me because I just like the sheer confidence of that man.
Exactly. I'm okay being 52% right.
Okay. Well, I'm really looking forward to it, Mark. Have a great weekend. Are you going up to the cottage for one last flurry, are you?
Yeah, it's going to be a few degrees above zero, so warm enough to go up there for
take advantage.
Take advantage of it because it won't be above zero for very much longer here in Toronto. So.
Oh, well, enjoy yourself. Look forward to seeing you next week.
Thank you, sir.
And have a great weekend.
You too. Take care.